It now gives me great pleasure to introduce our next presentation with the legendary Jack Bogle. While Jack regrets he cannot physically be here today, thankfully, through modern technology, we can visit him via two-way video conferencing. So yes, Jack can see if you're falling asleep or reading email on your iPhone. Jack will talk to us about the values, ethics, and standards investors should expect, a subject that we at Prime Quadrant take extremely seriously. John C. Jack Bogle is founder of the Vanguard Group, Inc., and president of Bogle Financial Markets Research Center. He created Vanguard in 1974, has served as its chairman and chief executive officer, and has been associated with the predecessor company since 1951. Vanguard is where Jack created the first index mutual fund. It is today the largest mutual fund organization in the world, with assets of more than $2 trillion. In his spare time, running the largest fund company on the planet, he managed to write 11 best-selling books. There are also a bunch of other books that chronicle Jack's life story and extraordinary career. These include John Bogle and the Vanguard Experiment, One Man's Quest to Transform the Mutual Fund Industry, The House That Jack Built, and The Man in the Arena. Jack's achievements are too numerous to list here. He has received countless awards for his contributions to society, including honorary doctorate degrees from 14 universities and the Woodrow Wilson Award from Princeton. Time magazine named him as one of the world's 100 most powerful and influential people, and Fortune magazine counts him as one of the 4 giants of the 20th century in the investment industry. Most importantly, he and his wife, Eve, are the proud parents of 6 children and 12 grandchildren. It is my great honor and pleasure to ask Mr. Jack Bogle to share a few words with us.
We're Valley Forge, Pennsylvania, up to you all in the great neighborhood out there in Canada. You're having a good conference, and I'm honored to be invited to join you. The subject that I picked for my talk today was basically about 10 or 15 minutes, I think, set back, and then we'll do the Q&A. Is the future of active investing and passive investing? And it really goes back to the initiation of this problem, or this issue. It goes back to the creation of Vanguard in 1974. We were a brand new company, and the first thing we did as an active business model was to create an index fund once we created Vanguard. And those two things are very closely linked in our corporate history, because we created this mutual structure where Vanguard is run for its shareholders and not for its external managers or for a financial conglomerate or for a big brokerage firm or bank. We are run for our shareholders. And low cost is our mantra. If we operate at cost, as we do, we will be and are by far the lowest cost provider of investment management services in the entire world. So strategy follows structure. That structure leads to a strategy. And the first thing, probably pretty obvious to you, is you think about where costs make a really big difference. Well, think about the index fund. Basically, the index fund is a commodity. Everybody has the ability to run it about the same way. Everybody can be solid anyway. So what will differentiate index fund A and index fund B is how much you charge for it. And we're charging now for most of our index funds around 5 basis points, 5/100%, and it makes a huge difference over time. I'll talk a little bit about that later. So the unique client-owned structure that led to the low-cost index-based strategy. So we created the first index fund in 1975 for our first board meeting. That was our first major decision. Vanguard started in the fall of 1974. The December board meeting in 1975. I should say the September board meeting, and we approved, the board approved the first index fund, and it was launched about a year after that. So it's all of a piece, to me, the strategy and the structure, the two things we'll show you that chart, a poster prepared by the Wall Street firm. Have we got that up there? Okay. You'll see that. Don't stand that index funds. Index funds are un-American. And in fact, the initial underwriting of Vanguard, it was originally called First Index Investment Trust. Now it's Vanguard S&P 500 Index Fund. Was a failure. The underwriters were going to try to raise $150 million. That was a decent sized offering back in 1976. And actually got $11 million. So Bogle's folly, was off to what I'm going to describe as a terrible start. But don't be discouraged, it's going to get better. So we dragged it along at $11 million. Finally increased to about $50 million. If you want to put that next slide up there, around $500 million by 1985, a decade later. And you can see what happened to the U.S. index fund industry there. Even by 1995, only about 4% equity fund assets were indexed, U.S. equity fund assets. And then all of a sudden, that 4% quadruples to 16% in roughly 10 years later. 10 years after that, today, that is, index funds in the U.S. total $4 trillion and account for 34% of the assets of all U.S. equity funds. So indexing has proved to be a revolution in American finance and the American mutual fund industry. So I mean, to commercialize Vanguard here, but so far this year, Vanguard has taken in, largely on the basis for index business, around $200 billion a little bit a year, and the average mutual fund, for the entire mutual fund industry, will have taken in about $160 billion. So $40 billion out of the active funds, $200 billion in for the index funds of the Vanguard, and the rest of the industry is shrinking as Vanguard is growing by a radical amount. I'm not sure it's great to be that big, but there it is, and that's what the public wants, and that's what the investors here in the U.S. want. So we have a history called the triangle indexing. And one of the things that went through, we should think about whether that started the index fund back in 1975 in the presentation of the board. Is that sustainable? Now, I had done a study of the mutual fund industry for the purposes of persuading the directors at that meeting that an index fund would work and would be sustainable. And if we go to that next chart, you'll see over on the right side the original study by the board showing that the average actively managed equity fund growing 9.7% a year over the previous 30 years, and the S&P 500 had grown at 11.3%, a 1.6% differential. So how would that look if we did it today? How did that stand up in court, if you will? So we went back just recently over the previous 30 years, that is to say, 1985 to 2015, and look at those results. 9.6% for the indexes compared to 9.7%, 11.2% for the indexes or the others, the large cap mutual fund, and a difference of the exact same amount, 1.6%. So it's been a fantastic 70 years. I'll throw in the 10 years that went between those two periods. So in the last 70 years, the total return on stocks here in the U.S. has been about 12% a year. We'll talk a little bit later about the next 10 years, but I think I can warn you right now that you don't want to expect a 12% return, probably something significantly less than that in the coming decade for a whole lot of reasons which we can talk about. So the idea stands up, the difference stands up because it's born by and large on the basis of cost. So let me just maybe look at a minute and we'll go to the Q&A. And that is the next chart. It says no great alternatives. Actually, a lot of people have mentioned my prediction of 4% for stocks, U.S. stocks over the next decade. And actually, I am talking about 4%, but my actual prediction for the next decade is 6% return on stocks. So that comes out of a formula I've been working on for 25 years. Just had an article about it in the Journal of Portfolio Management here in the U.S., which is based on where the returns of stocks come from, on the sources of stock returns. And they come from two places. You can see them identified on the chart, two sources. One is investment return. And investment return is the current yield on the stock market, I think S&P 500, and plus the rate of growth expected for the coming decade. And we usually do that on kind of a reversion to the mean basis. What has the long-term average been? And right now it looks like about 5%. That's discounted a little bit. It's actually higher than that. So we get to 2% yield, the dividend yield 5%. That's a 7% investment return. But I believe price earnings multiples will come down to these present levels around 19 times here in the U.S. Maybe go to 15 or 16. So that investment return will be reduced by speculative return, I call it, which is the change in the valuation of stocks measured by the annual change in the price earning multiple. These are things that happen in the market, reversion to the mean, and things of that nature. So it looks to me like the next 10 years, it will be that 7 minus 1 or 6% return on stock. The main alternative, of course, is bonds. And we'll go to that next chart, which is certainly no great alternative. The long-term return on bonds has been U.S. bonds, corporate government, has been 4.6%. We think in the next 10 years it should look something like 3%. At present, the U.S. 10-year Treasury is at about 2.2%, but with a little longer maturity in 10 years and a little higher corporate component, a smaller government component, it could, maybe a little bit optimistically, be 3% in the next 10 years. So and these are not very high returns. So we then go to the next chart, and I have to confess there's an error here, which we will try and deal with now, and that is if you add that 3% bond return and an expected bond return, reasonable expectation, and then a 6% stock return, you get a 4.5% return on the balanced portfolio. But it's marked out, if you would note, that 3.5% you see there, but 4.5%. And that's before costs, before inflation, before taxes, which on retirement plans would not be a significant beginning, and less investor behavior. Here in the U.S., we see mutual fund shareholders moving back and forth from winners that turn into losers, and the reality is that costs them, the Morningstar record, about 1.5% a year. So I'm not going to take those costs out. I'm just going to talk about 4.5% less 1.5% for active costs, less 0.05% for index fund costs. And the reality is, if you look out over time, 25 years in this case, I'm doing it, and if you get a 4.5% return, less 1.5%, you're getting 3% compounded for 25 years, and $1 million pension fund would then grow to $2 million. If you only take out 0.5%, essentially the index fund cost, you would get 4.45% return. And that same million, rather than growing to 2 million, would grow to $3 million. There's a $1 million profit versus a $2 million profit. It makes a difference if you consider costs, and if you look out over time, and not just at what may happen the next day, week, or month. 25 years is not a long time for a pension fund or even for an investor seeking retirement. And in many cases, they have far longer time horizons than that. So that's sort of the basis for the index fund. That is the reaffirmation of those early principles. And that is the importance of long-term investing and the importance of always thinking about costs. So now I'd be glad to take any questions you have there.
Jack,
Yes.
First of all, thank you so very much for joining us. We did send you some questions in advance. I presume you do not have those handy.
No, I do.
Oh, you do? Okay. Do you,
Why don't you?
well, my memory is not as good as yours, so perhaps you could feel free to lead us off with some of the questions that we emailed you.
Okay, maybe Mike Nolan, who's here with me, can read the question. I'll answer them.
Sure.
You want to read it? Sure.
So, Jack, what are the most important things that investors need to do and don't do enough of?
Okay, well, that's one of my fun subjects. The most important thing to do is diversify. Diversify your portfolio for a whole variety of investment options, a whole variety of stocks. Almost can't be overdone. Number two is think about asset allocation. That's really the number one decision an investor has to make. How much in stocks and how much in bonds. How much seeking gain, how much seeking protection. And those options are, as I've indicated before, not really a whole lot great today. Next is focus on the long term. I'm talking about that. The long term is everything. The next year or so just doesn't matter. Next, don't rely on past performance of funds to tell you the future. It is not predicted. It's easy to say, here's a great fund with a good past record. The reality is profound, that a very high record will revert to the mean, and below the mean become a low record. There's no predictability in looking at past records of funds, even for a decade or more. So you just got to not do that. And of course, finally, don't forget costs. Investors ignore them, particularly look over a lifetime of investing and consider your costs. So I think those are the most important things on the agenda.
Thanks, Jack. You've said that we're living in an age of the triumph of indexing. The message that you've been espousing on the benefits of index investing over the past several decades is now rightfully being embraced by institutional and individual investors worldwide. What further advancements do you see coming for indexing in the coming decades?
Well, that's a wonderful question, because in a way, I think we have over-innovated indexing. The fundamental indexing that we talked about when I started that first index fund back in 1974 or 75, it was called First Index Investment Trust. We're very proud of that first. And it was simple. It was essentially on the entire U.S. stock market. Hold it forever, diversify to the nth degree, keep costs at rock bottom levels, and don't peek. Don't keep looking at things. Don't be active. Be passive in your approach to investing, as well as owning a mutual fund that is passive in its approach to investing. It's both the behavior of the money manager and the behavior of investors, I think, often get us into trouble. So I think we should retrench a little bit, and will retrench a little bit. And with all the innovation that's come along in indexing, most notably the exchange-traded fund, there are good uses for exchange-traded funds. But by and large, they have two problems. One, they're traded at a frenetic rate. Here in the U.S., exchange-traded funds are traded at almost 80% of the turnover volume of U.S. stocks, common stocks, and with a much larger asset base of the stocks than the ETFs, probably 10 times as high. So the turnover is like 600% a year versus 100% a year, something in that range. And that's just speculation run wild. And we've also permitted in the U.S. a whole lot of, I think, very odd, kind of, to say the least, kinds of so-called index funds here. Now we have smart alpha funds that are called index funds. Not sure what that means, but I'm inclined to agree with Professor William Sharp that smart alpha is stupid. And I'll let him speak to that rather than me. I just don't see why they would work at all. And the other thing we've done is more into crazy kind of speculative game, where here in the U.S. and perhaps up in Canada, you can buy an index fund, let's say an S&P 500 index fund. You can decide, you can get it with triple leverage. Double wasn't enough, 100% leverage wasn't enough, 200% wasn't enough, and now it's 300% leverage. And you can decide and bet every day whether the market is going up or going down. I think that is the craziest way to invest I've ever seen. I don't think I'll be surprising anyone in the room there, because I'm sure you don't do it either. But it just makes no sense at all. It brings out the gambling instinct, the speculative instinct of investors, which is all too common, where they should be thinking about long-term investing and just staying the course. So less innovation would be my prediction for the future.
Jack, you've laid out your vision for the future of returns already. You said we were looking at probably 6% annual return over the next decade. In an environment like that, with low equity returns lower than normal, Is there more or less, or perhaps the same opportunity for active managers to outperform?
It doesn't matter what the level of the market is, given the ability of managers to outperform. Let me say a word about the whole U.S. stock market and make this very simple. As we stand in the U.S., around 30% of pension fund investments are indexed. And those 30% get the market return less a tiny cost. The remaining 70% of U.S. stocks own the exact same stocks, just twice as many roughly. And so the rest of the market gets the same return as the total market because we're taking out just a segment of the total market, if you can follow me there. It's pretty easy. But that the other group, like trading back and forth with each other, paying investment managers, is going to get the market return less than about 2%. I should say, more parenthetically, the reason I used 1.5% in my previous example was that was a stock bond portfolio, and bond costs tend to be less than stock fund costs. So you've got the whole market giving a 7% return, and all those active managers owning 2/3 of the market or 70% of the market are going to get 7% minus 2 or 5%, and the indexers owning the exact same stocks, just in different proportions, are going to get that same 7% minus 0.5%, or as little as 0.5%. So some active managers will win, some will lose under both cases, but the winners and losers won't be balanced because of the cost. And it's like a little bit like, if I may say so, like going into a gambling casino out in Las Vegas here in the U.S. Everybody bets. It's a zero-sum game, but the croupier wins. The man in the middle wins. In our case, the money managers of Wall Street win.
I'd like to talk a little bit about the retirement planning system. You've, over the years, been very concerned, expressed your concerns about pension system here in the U.S. and abroad. If pensions are targeting 7.5% return on equities, and equity returns something significantly less than that, say 4%, 5%, 6%, what will happen? What are the potential ramifications for society at large?
Well, they're not good. And let me first say that 7.5%, these pension accounts are by and large balanced accounts. So you really have to look not so much at the stock returns, but at the bond returns. And we can do that same mathematics I talked to you about before. A 4.5% return, less 2% pension funds would probably pay 1% because they're less expensive to run than individual accounts. And the index would still come in. They're not doing a lot of indexing, probably around 25% of the pension business index. But what happens? Today, U.S. pension funds, counting both corporate pension funds, which are large but not growing, and state and local government pension funds, which are very large and growing, they're today about 65% funded. They have assets that would cover about 2/3 of their potential liabilities. And so they're behind the 8 ball. And if they're assuming 7.5% and they get, say, 4.5 or 4, they're going to fall further behind the 8 ball every single year. So there are 2 and only 2 simple options. They're not simple. They're simple options. Simple to discuss, but not so simple to implement. One, they've got to raise revenues. That is, our corporations will have to make larger contributions to their pension plans, which will penalize their earnings. Or they've got to cut back the pension benefits, which are not easy to do. And our state and local governments are really in a worse state than that, because they will have to raise taxes to pay the additional pension contribution. But shareholders, or taxpayers, I should say, are more likely than not to vote those taxes down. They have a hard time changing benefits because the unions, state and local government unions, have been able to get these provisions about their pensions being fixed into state constitutions in some cases. So they are caught between, as it said, a rock and a hard place. But sooner or later, if you're caught there, one of 2 things must happen: higher contributions, both in corporate and in state and local, higher contributions or lower payouts. And that's not fun.
So you've had a long and storied career in the investment industry, Jack. If you had one message, one nugget of wisdom that you could give to investors that they should keep in mind as part of their investment strategy, what would that be?
Well, it's pretty simple. Number one, save. Number two, invest. And you really have to invest in some combination of equity and bonds to get any chance of building a retirement account, because savings is producing nothing in the U.S. and I think around the world, and bank savings and so on. And just get your asset allocation right, as I said at the outset, and get the costs out of the equation, and then stay the course. I've often used a rule called don't peek, don't look. Take those statements if you're a retirement plan investor each month and throw them away. Don't even open them. And as I tell people, if you do that, once you get to your retirement date and open that envelope that comes in the mail, that's the one you open, the last statement. And my warning to anybody doing that is pretty simple. I haven't looked at it, don't forget, for 25 or so years. And that is, have a good cardiologist next to you, because you will probably get a heart attack when you see how much money you've accumulated. So don't open the statement, don't peek. This is a little hyperbole, but the idea is the right idea. Don't pay too much attention to the short term. Focus on the long term. And if I could get all investors to do that, this revolution would move even more rapidly than it's moving today.
So let's ask you to look into your crystal ball for a moment, Jack. If we were sitting here 5 years from now and reflecting on recent changes in the investment industry, what do you think would surprise us the most?
Well, first I'd say, we've had to put these in a really good order. First I'd say, at least 1/3 of all the exchange-traded funds in the U.S. will be gone. We know from historical experience that at least 1/3 of the mutual funds in the United States go out of business every decade. So make sure you make good choices of things that are durable, strategies that are durable, and funds that are durable. We'll also see, we'll have a whole different generation of money managers, even 10 years from now, because in the U.S., the average mutual fund manager lasts 8 years. And I said a little bit tongue-in-cheek, but not entirely, about the great advantage of index funds instead of having over an investment lifetime, because of funds going out of business and managers lasting for only about 8 years. You're going to have 30 or 40 managers, 4 or 5 mutual funds, active mutual funds, and the possibility they will outperform the index is just about zero. So what I say tongue-in-cheek is, a little bit tongue-in-cheek, is the guarantee the index fund gives you is we promise to have the same non-manager running the fund 50 years from now as is running the fund today in 2015. That might not seem like a lot of, it might almost seem funny, but when you think about it, that's the durability of the strategy. They're not relying on human beings and taking cost out of the equation. So there will be change. Indexing will grow. It's hard to see how far it'll grow. But I should just mention this canard about the fact that as indexing gets more and more important, which it will do, it'll be easier and easier for active managers to win because the market will be less efficient. No, that is not the case. Because no matter how efficient the market is, inefficient the market becomes. It may be easier for good managers to do better, easier than it's ever been, but it has to be easier for bad managers to do worse. They have to balance out. The equation of the market is the market, and all we're doing is talking about trading stocks with one another, trading strategies with one another, trading investors with one another. Is a zero-sum game until you get into cost. So the more people understand this, and I think more understand it every day, not only but just about every academic in the United States tells the same thing about they're all basically indexers. I get letters from active managers and hedge fund managers telling me that they're indexing their own accounts, and these shareholders are happy. Another thing that's going to happen over the next 10 years is people are going to learn from their own experience what works and what doesn't. And when they find that the present system doesn't work, they're going to be converts to a new, simple, low-cost system, which is basically owning a nation's business or the world's business and holding it forever.
Jack, thank you for sharing your thoughts with us. I'm going to throw it back to Mo in Toronto.
Thank you so much, Jack. That was absolutely wonderful. I'm not sure where you're seeing me from, but You certainly gave everyone in the room an enormous amount to think about, and we cannot thank you enough for sharing your insights with us, and we hope that you continue advocating for the interests of investors for many healthy and fruitful years to come.